Ira Epstein of Linn and Associates with your metals market update for this Wednesday, the 1st of May, 2019, just past 4:30 p.m. Central Daylight Time. You know, I was watching the markets and I was wondering, did the U.S.-Chinese trade deal go bad this morning? Because copper was down 10 cents early on. And I'm going, what is it? In thinking back, probably the softness of the ISM manufacturing data did the market in. Then, of course, we looked at the Fed, and the Fed is saying at the end of the day, because the Fed didn't come out till 1 o'clock and the damage in copper and silver had already been done, and the Fed was just talking that they're not moving off their point. They don't see a reason to cut rates. They don't see a reason to raise rates. A bull market and stocks like more bull news, and they didn't get what they wanted in the sense the Fed wasn't saying, gee, yeah, we're going to lower interest rates. And I think the market had already, to a degree, been building in a rate cut as early as September. Now, if you go back after today's press conference, it's further out that they're looking. But gold held up relatively well, as it's the other metals, the real industrial metals, absolutely came unglued. When we take a look, gold for the week is down 70 cents. So you can't say that it's gone anywhere for the week one way or the other. It's still under what I'll call the bearish thrust in the market, because you've got the lower highs, lower lows, and you closed under, or you're still under, maybe I should say it that way, the 18-week average of closes. When you look at the chart, today's action's interesting in that you have an outside day down. That means you took out Tuesday's high and low, and you closed lower. Now, a trap signal for those that want to be bearish would be taking out today's high, and that number is 1289.40, either on Thursday or Friday. But barring that, that's the number that I think the bears have to defend, not letting the market get over that number. It also puts the swing line down again, and we haven't seen that in a little bit. You got into this corrective mode right here. Now you're back to the lower highs, lower lows. When we look at moving averages, you know that if you're a regular watcher of this, I think that 18-day average of closes is a number, one of them, that the market often looks at to figure out what it's going to do. And I think it answered today for the time being, until today's high is taken out, that it wants more of the downside. It's acting bearish. You've got bias down because you're under that. You've got the lower highs, lower lows, which I define as a trend. The market could be saying it wants to move to the lower Bollinger Band at 1264.50, and it is not an oversold condition. Both numbers, or even one of the numbers, are not under the 30 level, and if they close under 30, that's when I think you're oversold. So I'm going to say the resistance showed itself again in the market looking on the weak side. When you come to the ETF GLD, it's the same. Lower highs, lower lows, outside day down. Take out today's highs, and then I think you knock out the bear trend for the moment, and you put into play possibly getting to the 100-day average of closes, 122.02. Like the futures market, the market is trying to correct. It hasn't done it. The difference here is any reading under 30 is oversold. If you come back to the futures, both numbers are over 30. So I see this market is oversold. Doesn't mean it can't go lower, but it's not the ideal being super bearish number. Here's where you're super bearish. You see how GDX has got the embedded reading, the outside day down? Now you even got a bearish crossover. You got the 18-day average in red under the 100-day. Will the market make a run for the lower Bollinger Band and find any support down there? Well, as a chartist, take off the name of the chart. That's what ideally in a situation like this I'm looking for. Where would the problem be? Because you got to balance everything. If today's high were taken out, you break this pattern, create what I call a bear trap out of this, maybe it gives the market the muscle to get back up to the 100-day and the 18-day average. But regardless of what happened, that would be where I'd look for the resistance to come in. The problem would be you'd break the pattern of lower highs, lower lows. The gold-silver ratio exploded. I mean, just exploded, where gold being only down $1.50 and the silver market down 25 cents exploded today. It was a collapse of that, and that's what you're seeing here. As this market yesterday was here, now I've got to pick it up to 87.69. It hasn't been here. So this is a new high on that move. It doesn't speak well for industrial metals, of which silver is one. lower highs, lower lows. Admittedly, the first challenge outside of the Bollinger Band often, in fact, always, I tell traders, that is not a spot that I think the smart money is going to start selling under these bands. And the reason is the market will stay within them 95% of the time. Just like if you go to the soybeans or you look at the cattle, it can go in a vertical line. But it's not what one typically plays for. You're playing more that it's going to get bounces from there. That is not bullish. This market's still committed to the bear side. It is oversold, and I do think the pro money, some of it came out of the market today on the short side. In the copper market, if we look at yesterday, you went back up, didn't quite take out the previous high. You were right against that 18-day average. You know how often I say that 18-day average is the line in the sand. Now, I'd normally be telling you, look, if you break down for support at the lower Bollinger Band, if you take that out, the 100-day average. It is a Fed day. It's a dangerous day to be trading some of the metal markets. The market didn't even pay attention to those two numbers. It cut through them just like it was soft butter. Okay, but the odds are the market will get back into those bands and still pay a bit of attention to it. It's nothing bullish. The chart is still bearish. This is a new break low on this whole move. We haven't been down here. If you take a look at it, you have to go back to the beginning of the year to get down into areas like this. So quite a bit of a bearish scenario. Imagine, though, if overnight they said, well, we're doing a deal with China. Would that change things? Who knows? Higher high, lower low, under the lower Bollinger Band. So one of two things happens here. Either the market tries to get back over that Bollinger Band, and it would have resistance if it did at that number and potentially the 18-day average, or if it just let go of everything, like you just saw in the copper, maybe you go down to the 100-day. The key is it's not trending. It's a volatile time. You're getting no follow-through up. The question is, will you get follow-through to the downside? In the palladium market, we had this one pretty well idealized in terms of the Bollinger Bands acting as the resistance. Then you had the outside day down, and that was on Monday. If that gives ground, then the 100-day and the Bollinger Band come into play. Are you trending? No. You've got now, at this point, you've got 1350, 260 is the key number. If you take that out, you lose the higher lows, higher highs. This was, remember, Monday. Yesterday, you broke that trend, and you did stop at the 100-day average. You're still not trending. If that gives ground, then I'm looking for what? The lower Bollinger Band. If the market rallies from here, it finished at 1382.70, so the resistance can't be the 100-day average, the 18-day average. It has to be the upper Bollinger Band. Instead, this market let go, took out all that, went to the lower band, and that's where it found some support. Last, in the dollar index, you broke down deep enough now to take out a previous break low. So the market is neither bullish nor bearish. I'm going to call it now neutral. It's run its course up here, found support where I would think it would, the 18-day average, the first challenge of it. Now the question is, what's next? You have a divergent chart. You've got momentum pointing down, the bias up because you closed over the 18-day average, and you've stepped out of a trend that prior to today was still one of higher lows, higher highs. I would think that on the first challenge of the 18-day average, it tries to find support there, and it did. That's how I'd sum that up. You know, one of the things I do each morning, believe it or not, I start recording at 6:15 a.m. Central Daylight Time. You don't see those videos. They're only available through our mobile apps, our trade platforms, or our website via a subscription to them. But let me tell you what I do. It's 45 charts typically in the morning, 40 futures, 5 ETFs that I try to get done for you. In it, the charts look like this. Those are the color combinations that I use. I add more studies and I give you a lot more information because I'm able not only to cover this in a certain way, and this is the exact sequence of the markets, how I cover them each and every day, but I'm able to tell you what I see the chart action is, what I think the pros are doing. By 6:15, I already have a good handle on what's taking place overseas overnight and where the markets are looking for pre-openings and the like. Plus, I'm using live charts. And remember, electronic markets are open in most cases. And I'm going to throw out, unlike here, Very specific. Buy here, sell there, do this. Here's another option strategy. Yeah, I'll throw out some longer term. Then I'm also looking at position trades and swing trades. So it's a lot more than I'm able to write about in any other way. This is how I do it. So at 6:15, I record. By 6:30 or so, I'm typically through. I'm starting to render, and that's what you got to do is you record. Then I'm posting to the internet. This stuff's typically up before 7 in the morning. As I said, it's a subscriber video. It's not expensive. For the first 30 days, if you want it, 26.5 cents a day roughly, $7.95. After that, should you decide to go on because there's no contract, it's $15 every 30 days. I don't care what day of the month you begin. If you want, you can convert over to a 1-year subscription for $156, which is the equivalent of $13 a month. But think what you're getting out of it. You're getting somebody that is throwing out their best knowledge they've got. If you're watching these videos and you're a regular, think of what I'm saying. Now I'm able to throw out the buy here, sell there, do this, right before the markets get going for you during the day. Pretty interesting. And of course, you can watch it anytime during the day you want. How do you get it? You can either call my staff, they'll work with you, get you signed up. You can do it online. It's simple. Go to our website. Under research or subscription, you're going to see Ira's morning subscriber video. Click it. It explains it all. You sign up right there. You can even click up here. If you're on YouTube, it'll take you to that page. I'm Ira Epstein. It's pretty interesting times. Interesting information. Maybe I can throw you with an idea or two or help solidify your own trade ideas. I'm Ira Epstein. Have a good day.